Get Rich Education is brought to you by Norada Real Estate Investments and Mid-South Home Buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
This is Get Rich Education, episode 55. I'm your host, and my name is Keith Weinhold. Thanks for being here from wherever you're listening. Coastal Galveston, Texas, the streets of Teaneck, New Jersey, the fertile rice paddies of Vietnam's Mekong Delta region, or the mountainous green coffee country of Boquete, Panama. I'm here to build your wealth. So, welcome to the show. Today, we're going to chat with the author of The Philosophical Investor, Gary Carmell, on how you think about investing and also U.S. and global monetary policy. Speaking of being an international show, we've got some constructive criticism here from an avid yet frustrated GRE listener after he heard the last show. This is from Ricardo in the Netherlands.
Hi, Keith. Ricardo here from the Netherlands in Europe. I'm glad you have this application. It's pretty nice just to speak up what goes through your mind, because the hassle of having to go to the email and writing, etc., takes forever. And it also takes forever for you, not just for us. So I guess you get a lot more feedback this way. Anyway, I just want to express, I love your program, first of all. So this is not at all a critic, but it's just constructive feedback from somebody who listens for so long and is European-based, not US. I think the program is very US-centric. Today's program, again, credit report. This is pretty useless for us in Europe. And it's not the first nor the second or the third episode that I listen and realize, why am I even listening to this? I cannot make anything out of this information here in Europe. So depending on how many viewers you have that are coming from Europe versus US, try to somehow include us more in your podcasts, in the information that you provide. It's probably not very easy because it's all very dispersed, some from the Netherlands, some from Germany, some from Spain, some from, France. And it's all very locally based with the local rules, etc. So it's probably not easy for you to provide information to each of these individual countries. But I don't know, just something to think about, that there's more and more frustration from the European listeners when you do these US-centric programs. Thanks.
All right. I really appreciate your feedback there from your home country in the Netherlands, Ricardo. By the way, Ricardo publishes the finance page called Contrarian Straight Talker. Well, there's a lot of perspective to view from this. For example, many in the U.S. state of California have to think twice before investing just in another U.S. state like Tennessee. That in itself is a quote-unquote foreign concept to some, even though they're investing within the same nation in which they live, okay? I think I already do more than most shows, and certainly more than most real estate investing shows, to discuss the global perspective, but I'm not really trying to be like most real estate investing shows anyway, but I'm often asking guests just one question in our interviews about whether certain programs, policies, or ideas translate internationally. And then as soon as they answer, I kind of leave it at that and move on. In fact, I did do that during the credit scoring episode that you're citing there, Ricardo, which was just last week. But I think what you're saying to me is that you'd like me to go even deeper than that. And I guess in short, here's what I have to say about this. Get Rich Education is not United States exclusive, but it is United States centric, and it is going to remain that way, okay? There are a few reasons for that. Number one is that, I live in the United States, so I know these markets the best. And number two is that, frankly, most of the best cash flowing real estate deals worldwide are in the United States. You just can't get that 1% rent to value ratio on very many properties elsewhere. European listenership overall is 8 to 10% of GRE's total listenership, and the Netherlands is the 21st most popular GRE listener country, and I really appreciate having all Europeans as listeners. Just to provide a little more color, our number one European listenership country is the United Kingdom, and they're the fourth most popular GRE listener country overall. Now, if I learn about a cash-flowing European real estate market that has a rule of law, a diverse economy, sustainable job drivers, a vetted management team, a good rent-to-value ratio, then, yeah, I'd consider featuring them on the show, but, only even then after I got some positive feedback from others in the investing community about that particular market, and perhaps only after traveling to Europe myself to visit as well. So that wouldn't be happening anytime soon, but yeah, I'll stay open to it. Many of the markets of Northern and Western Europe have rent-to-value ratios of about 0.5%, okay, where you can still get a full 1% or more here in the better U.S. markets. We have listeners in 143 nations, so I guess if I try to please everybody, then I won't please anybody. If I were listening to a Netherlands investing show with a host that was born and raised in the Netherlands, then, I'd probably expect that host to mostly discuss the Netherlands and the EU countries just the same. So I hope that feedback helps, Ricardo. I don't know if you got 100% satisfaction from that. Even though your message has a critical bent to it, I appreciate you for taking the time to care. So thanks for that, and thank you for your faithful listenership. In fact, pretty soon, my wife and I are headed to both Panama and Nicaragua to check out some agricultural investments there, so there will likely be a feet-on-the-ground international investing report from me on location between now and December as well. So, hey, well, if you have any praise or criticism of the show or just a question, feel free to do just what Ricardo did. Land on GetRichEducation.com. From there, you'll see that little widget over on the right that says send voicemail, and you're only 2 clicks from recording, maybe it's 3, and you can use that SpeakPipe app right there. That's that widget that I just described. There's no guarantee I'm going to play your voice on the air, but if I think that your message can help enough people, then I might play it. We probably get 10 to 20 times as much feedback praise as we do feedback criticism here, but as you can see, I will surely play criticism of the show on the show. And if you don't like the voice approach, send us a message at the contact page there at GetRichEducation.com. GRE's mission is to help you build your wealth greater than you ever thought possible. And we do it in this way. We cultivate an abundance mentality to invest, especially in real estate, for an outcome of lifestyle improvement. Before we get to our featured guest today, I've got this great 36-page report from Maverick Investor Group in front of me. I printed it out on paper, old school style. It's right here. It's called How to Avoid the 7 Biggest Mistakes Real Estate Investors Are Making in the 2015 Boom Cycle. There are a few interesting things in here worth mentioning to you. Right in the introduction of this report is a pretty strong statement, and one that is just 100% correct, and it surprises some people to hear this. This is what it says. I'm reading, investors who make the wrong decisions will lose big because the reality is that most real estate gurus and investment property promoters, what they won't tell you is this. Most real estate is not a good investment. Okay, let me just repeat that for emphasis. The report doesn't repeat it, but I will. Most real estate is not a good investment. Yeah, that's true. If you go pin 3 maps onto your wall, and each map represents a good cash-flowing investment property market, say Indianapolis, Memphis, and Chicago, and you throw 3 darts, one at each map, and you purchase the property closest to where each dart lands, you're probably going to end up with losers. Yeah, even in Indy, Memphis, and Chicago. I say that the market is more important than the property, but it really goes beyond that and down into the sub-market, the specific neighborhood that you buy your property in that has working class jobs, yet it is not crime ridden. I mean, if you buy Chicago property on the Lake Michigan lakefront, it's going to have a nice view, but you're never going to get the rent to value ratio to make for a sustainable stream of income with an 80% loan on it. That's because owner-occupied homeowners on the lakefront, they'll pay more for a property for that view, and all the RV ratios get knocked out of whack and diluted because the rents just don't keep up proportionally to that higher purchase amount. So unless you know specifically what you're doing, I mean, one could possibly pull it off to go into these markets themselves without that grounded local knowledge, but that is a great recipe for failure. If you invest out of market with no strategy and without, leveraging the help of a team like a Maverick, an investor could find themselves discouraged at best, in a slack-jawed state of economic despondency at worst, okay? Even if you found the right property and rehabbed it yourself and rented it out to someone all by yourself, you still need the right team for that ongoing management and maintenance. And you don't want just any property management company. You want an accountable manager when you don't live in that area. And communication from your manager is key. You don't want some half slack-jawed management operation that rents units to a tenant without making them leave a sufficient security deposit, whom is moving in their 50-gallon terrarium with Burmese pythons in it. I mean, the market, the sub-market namely, and the team, especially the manager, it's easy to argue the fact that they are more important than that property. Yeah. So, okay, back to this Maverick Investor Group report here. It outlines the advantages of owning hard assets, real estate's tax advantages, passive residual income, a section on how leveraged real estate is a hedge against inflation. You've got a section on how people confuse property flipping with real estate investing, the mistake of buying real estate-backed securities instead of freehold real property, the mistake of buying commercial property instead of residential, how student loan debt is turning millennials into generation renter, something I've talked about on the show before, the mistake of sitting on the sidelines and hesitating to buy property, the mistake of real estate speculating, the mistake of failing to perform due diligence, and more mistakes that real estate investors are making in this Maverick Investor Group report. Maverick's motto is turnkey real estate investing for smart people. You don't have to buy this on Amazon. You can get this same free report right on our GetRichEducation.com homepage. And it sure reads a lot faster than 36 pages with these testimonials and graphics that take up quite a bit of the area on the pages. I want you to grow substantial streams of sustainable, durable, and diverse wealth. So, hey, here we go. We're going to have a little chat from Anchorage to Orange County, California, as we meet the philosophical investor. CWS Capital Partners was founded in 1969. They're a real estate investment management company that specializes in the acquisition, development, and management of apartment communities with a very large presence in Texas and also in the metro areas Atlanta, Raleigh, Charlotte, and Denver. CWS owns, operates, and builds apartment communities around the country. They hold 23,000 units worth more than $3 billion. Gary Carmell is partner and president at CWS Capital. Gary authored the popular book, The Philosophical Investor, Transforming Wisdom into Wealth, published in March of 2015. It's a real pleasure for me to welcome onto the show today, Gary Carmell.
Well, thank you, Keith. It is my pleasure to be here.
Hey, Gary, I got to say that's a really intriguing, engaging sort of name of your book, The Philosophical Investor, Transforming Wisdom into Wealth. What's kind of the idea or thesis behind the book?
Well, I found that in my nearly 30-year investment career, and I've actually been with CWS since 1987, so that's the bulk of my business career. So I kind of came in on the ground floor and was able to see what it's like to be investing through various economic cycles and the ups and downs. And I came to learn that really we need multiple tools in our toolbox, and that if we can take a left-brained approach of utilizing financial principles and analysis and marry it with a right-brained approach, which is looking at the world a little more holistically and creatively, that combination allows us to gain better insights, maybe ahead of what the consensus is thinking or believing, in ways that hopefully we can add value and make good investment decisions. So it's really learning from others and how human beings react and behave in situations with imperfect information. They're consumed by fear and greed and all of the human failings that we have. And then learning about ourselves, what makes us tick, what brings us great joy, what brings us fear, and how do we marry those two together to know more about ourselves and to learn more about others in ways that can allow us to have, unique insights that can keep our head when times get tough, and to take advantage of those opportunities when they're available to us. And so that is why I called it the philosophical investor. And the subtitle is Transforming Wisdom into Wealth. And really, at the end of the day, I end the book talking about how wealth just goes far beyond the financial realm. And so how do we take the wisdom we've learned in this life that we have and create true wealth from that beyond just money?
What might be an example of transforming wisdom, which is typically built up through a series of experiences? What's an example of one transforming wisdom into wealth, Gary?
I've had some, on a very personal basis, I've learned through some experiences with my son when he was 2. He had an out of the blue event, a health event, where he actually had a stroke as a result of a rare reaction to the chicken pox. And so he almost died. He was in the emergency room. And to this day, so he's 22 years old now, and it's been a challenging life, yet a very fulfilling life. And it came to learn that one of the things that I characterize as a wealthy person is someone that has resilience and that can bounce back from setbacks in the emotional, financial, health arena, spiritual arenas, and they can come back in a way where they're stronger as a result of that experience. So this was one of those out of the blue tectonic shifts, and I talk about what tectonic shifts are in the book, that taught me, when you can bring a family together and bring love and caring to a very critical situation, that can go far beyond what your financial resources are.
Yeah, and that situation certainly has a lot more gravity to it in dealing with what you needed to deal with your son than it does for an investor to deal with a depressed market, perhaps, because usually when a market is low, that's when people get the most discouraged. So people get the most discouraged exactly when the greatest opportunity lies there, when a market is at a low.
Boy, you're absolutely right. And connecting that experience that I had with that truly helped me gain some perspective. Because if you haven't had setbacks or challenges, they can be all consuming and they can really throw you for a loop. And that's exactly the time, as you say, that you have to find the strength, the courage, the resilience to take a step back and study history, study human nature, and realize that this too shall pass. And then how do I transform this into an opportunity rather than letting it get me down? So I like to say in the book, I talk about these tectonic shifts that are these events that change the trajectory of a business, industry, or life, and that if you're not prepared for them or react to them in a healthy way, they will monetize you by either you losing money or not gaining valuable experience, or you can turn the tables and monetize them and doing the reverse, making money from it and gaining vital experience.
Yeah, so whether it is a real estate market that we're talking about, or a stock market, or a gold market, when the market is low, okay, that's when people get discouraged and they probably don't act in the way they should. That's when they should be buying. When a market is high, people are kind of giddy and, By that time, it's almost permeated society. That's when people are getting stock or real estate tips from their Uber car driver because everyone is exuberant about the price run up. So people are kind of irrational at both the market crest and the market trough. So speaking, philosophically, the philosophical investor, the attributes that might be more valuable to an investor than some classical attributes like hard work or intelligence. For an investor, words like discipline and courage are probably what make for a successful investor, even more than hard work or intelligence.
I would definitely agree with that. I think there have been some very interesting studies about returns that are generated for different asset classes over periods of time, and then the return that's generated by the individual investor. And it's usually a big gap, and they call that the behavioral gap, where people, a certain mutual fund may have an average return of, say, 10%, but the average investor in that fund has gotten 6 or 5% because they tend to go in towards the top and leave towards the bottom. And it's that inability to tie ourselves to the mast like Odysseus did in the Odyssey. It's one of the analogies I like to use.
Right.
To avoid the sweet siren call of perceived easy money, or the envy of missing out, or the fear of, oh my God, I just feel like I'm really not a very smart person because I own this and things are not doing well. And so, as you said, we have these ways of compounding in, very negative ways if we kind of overthink things, or we think we're smarter than everyone else, and we have this level of overconfidence or this fear of looking foolish that leads us to make suboptimal decisions. So I think you're right. If you can try to understand something very well, not get in our own way, and have the courage and the resources to pull the trigger at those opportune times, then we can make a big difference in the financial outcome of our lives.
Yeah, and I know you have something, I believe it's in your book, that you describe as the Munger moment, which is something kind of related to Charlie Munger, who is the second in command, Buffett's second in command at Berkshire Hathaway, for those that don't know. And Warren Buffett, he's the one that says, be fearful when others are greedy and be greedy when others are fearful. And that's kind of what we're talking about. Does that relate to the Munger moment, Buffett's right-hand man, or what does the Munger moment refer to?
Yeah, it really does. I mean, Munger said that truly great opportunities are few and far between in our lifetime. But what happens is that if we can take a step back, have an independent way of looking at the world, and be familiar enough with a type of investment or an industry where we know when the odds are dramatically in our favor, that the rewards significantly outweigh the risks, then all we need at that time is the resources to put money to work. And those resources have come about because we've been patient while everyone else has jumped into the fray and bought at the top. And when they're suffering and the avalanche has occurred on the mountain and they're trying to dig themselves out, you're there, unencumbered, you're free. You can, buy these lift tickets for free, essentially, or be given to you. The mountain is completely clear now and it's much safer. And so all you need then is the courage. So you've built up these resources, you recognize the odds are dramatically in your favor. And if you bring courage to the table, you can make an investment or a set of investments that, as I alluded to earlier, can change the financial outcome of your life.
Yeah, maybe that's a good time to think about opportunity cost. When a market is a low, what opportunities am I missing out on or not? And you really have an opportunity cost of inaction when a market's at a low, because when a market's at a low, you don't have a whole lot to lose. The only problem is, no one really knows when a market is at the high or is it the low.
Yeah, it is very difficult to time it so precisely. I think what most investors who are successful over the long term have is staying power. So they're able to ride out the storm and then have the resources when they think a bottom or a set of conditions that suggest a bottom are appearing. And then they can deploy those resources, with the independent thought and the courage. So, yeah, I think you're right. We can't call it, but what we can do is we can study human behavior, human nature, cycles from the past and some of those characteristics. You can follow the headlines and see the negativity or the over-optimism. And ultimately, you're going to have to develop somewhat of a gut feel because it's as much art as science. But if you have a long-term horizon and staying power, you're typically going to be rewarded for stepping in when others were more fearful.
Yeah, and I think to have staying power or willpower, what really helps is, well, really kind of what my style of investing is and what I talk about on this show an awful lot. With real estate investing, real estate is kind of a game of attrition. If you can just hang in there long enough and persevere, you are very likely to be a profiteer. I'm really into buying properties that provide cash flow from day one because cash flow is a more predictable metric than appreciation is. And we typically buy properties in markets in the Midwestern United States and the South, where you kind of do have these more stable, low beta, low volatility sort of markets from an appreciation perspective, where they just tend to chug along at maybe a 5% appreciation rate or so. But even if the value of them would drop a fair bit, again, you're in a low beta market, so they're probably not going to drop as much as they do on the coasts. You still have that cash flow. So that cash flow that still pays you every month while you hold on to it makes it a lot easier to persevere and to hang on and to win that game of attrition over time. In fact, if the value of the property does drop, your return on a return on equity basis actually goes up as long as it continues to cash flow.
Yeah, it is a great buffer, between those who are just betting on growth and, from a speculation standpoint and are levered up pretty aggressively with the expectation of a better future versus going in and buying with that margin of safety of a dividend yield and tangible cash returns. And especially if you can redeploy that income into other investments and kind of have it compound, it is just a wonderful wealth creation tool and a way of managing risk. So we're very strong believers in that as well.
Yeah, it is the greatest wealth creation tool that I know of, where you can typically get total rates of return when you add up all your sources of income on real estate. Rates of return on a total basis annually of 20-some% are not at all out of the question when you consider leverage appreciation, cash flow, tenant pay down of the loan, the tax benefits, and the inflation hedging benefits. I just don't see where an individual investor is beating that. Do you?
No, not. There may be individual examples here or there, but as an asset class to store and grow wealth with tremendous tax benefits, and from an estate planning standpoint, there are also wonderful benefits. It just has a compilation of features and attributes that are really, really difficult to beat. And I couldn't agree more with you.
Gary's president of an institutional investment company. We're going to talk about more of that when we come back. I'm also going to ask him about inflation versus deflation and why he often favors variable interest rate mortgage loans over fixed rate mortgage loans. You're listening to Get Rich Education. My guest is author of The Philosophical Investor, Gary Carmell. More when we come back. I'm your host, Keith Weinhold. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Hey everybody, this is Matt Bowles from Maverick Investor Group. You're listening to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education with the philosophical investor, Gary Carmell. So, Gary, you're the president of CWS Capital Partners, an institutional investment company. So, one thing I've always kind of wondered and want to know more about, and I've become more cognizant of institutional investment companies because oftentimes when they enter a certain metro market, it drives up prices and suppresses cap rates on properties, and that makes it less profitable for an investor. Why is it that institutional investment companies often seem to target these kind of nicer, high-end, Class A, newer built properties that have a lower cap rate, and that's where they often direct or funnel their money? Why is that? Why do they put them in those nice properties that don't produce the better yields?
Well, oftentimes their source of money is typically pension funds, endowments, institutions like that have very long-term perspectives. And so they have to place a lot of money. It's very inefficient for them to do smaller deals. And so these, higher barrier to entry, higher cost markets, they're able to deploy more capital. They can take a longer view. I guess there's also a political aspect to it where it's, hard to get fired for buying Manhattan real estate, as opposed to somewhere else, perhaps. So I think those are some of the main reasons for it.
Yeah, I guess there's something to be said for that. It's just easier to come under fire if you bought in a little ho-dunk town relative to a San Francisco or a Manhattan, and that implodes on you versus a popular, flashy coastal market.
That's absolutely right. They call them the smile markets, where you kind of take the smile and you overlay that on the map of the United States, and there's a lot of reasons to be in there. Plus some of the high barrier to entry markets like New York, Boston, Chicago, San Francisco. We're in that phase in the market where, as you said, they're really high beta markets. So as you have economic growth equal or greater than the rest of the country, the supply response isn't like it is in other less barrier to entry markets. So the rent movement tends to be quite a bit higher.
Yeah, that's fair enough. We have seen cap rates run down in quite a few markets. And, when the cap rate on a property, especially in some of these coastal markets, goes below the interest rate, that's basically the definition of zero arbitrage and negative arbitrage, and something that you want to stay away from. What do you see interest rates doing in the near term, Gary? And how do you use interest rates when you go ahead and put together a portfolio of properties for an investor?
Yeah, it's interesting you talk about the negative leverage versus positive leverage. For the first, I don't want to say 20 years of my career, it was very, very rare where you would have positive leverage. It was almost always the case where the cap rate seemed to be about 1 point below the interest rate, was my experience. So what we've experienced, there wasn't much activity in 2008 or so, but 2009 and 10, going forward, is we've seen this wonderful environment of positive leverage. And so we've had this declining interest rate environment and now fairly stable interest rate environment. And there's something called recency bias, where you take your most recent data points and you just extrapolate that to the future, which is something I'm probably falling prey to with regard to interest rates. But I've been in the camp for a long time that I thought rates would come down and stay down for quite a long time. I went back, and this is covered in the book somewhat, but tried to find some historical parallels to what we were going through in 2008 and 9 with the Great Recession, and did a lot of research in what was happening in the 1920s and 30s and what the reaction was of the federal government in terms of spending and the Federal Reserve. And when I kind of put all that together and my research I had done on the monetary system and how I thought that worked, I was of the belief that the deficits that we were experiencing, that a lot of people thought would lead to inflation along with QE and that combination of the two would actually, to me, were necessary for the economy, and we would not have to worry about inflation, and that these were necessary to fight off deflation, and that rates would remain low for a fairly lengthy period of time.
Well, yeah, because there are many commentators, maybe some of them that did not take the historical perspective that you did, that predicted by this time here, late 2015 into 2016, we would have seen some significant inflation. And it was actually pretty easy to believe that 5 years ago when people were predicting that. I mean, to come out of the mortgage crisis, the Fed bonds basically printed money, 3.5 trillion with a T, that much of it. I mean, we're talking about an amount the size of the German economy just to go ahead and pull us out of this by effectively printing dollars. I think it's very easy for a lot of people to predict that we would have had inflation by this point, but instead we're seeing inflation be rather mild. A lot of money still hasn't come off the bank's balance sheets. We're facing more globalization, which kind of fights against inflation. So what do you think? Are we headed for less mild inflation, where inflation is going to rise back up to historic levels, or could we be going into a deflationary environment here over the next few years, Gary?
I think we'll continue to see a benign inflationary environment. I think one of the, miscalculations or mistakes that people made is there was a lot of talk of printing money, but technically what happened, and I think this is an important distinction, is it was really an asset swap where people that own bonds essentially sold those bonds to the Federal Reserve, and now they were sitting with cash. So they swapped one asset for another, and that cash that they were sitting on was a lower yielding asset. Rather than going into the real economy, went into the financial world or the real estate world. So I think that it has served to inflate asset prices, but has not had the desired effect necessarily on, quote, the real economy with greater spending, more full employment, higher wages. And so I think that there are a lot of forces in the world, including demographic forces, the overcapacity in China, what's happening in the commodities market, more of a globalized economic environment. I think when you put all those together, it still speaks to me of a benign inflationary world with interest rates, continuing to be moderate.
Yeah, you mentioned the demographic influence. And today, most of the developed economies in the world have quite an aging population. An aging population does not correlate with inflation.
We don't really have a lot of historical precedent for what's happening in terms of the aging or even population declines in some industrialized countries, with the possible exception of the plague, back in the Dark Ages. So Japan is definitely leading the charge with regard to an aging society and a shrinking population. And I guess one could argue that labor would be in increasing demand, perhaps because of a shortage. But at this point, I think Japanese are very innovative and industrialized and working with robots. So I think they'll find ways to increase productivity. So at this point, Japan obviously has no inflationary risks or challenges on its hand, and deflation is more the issue. You've got same population challenges that are going to be materializing in Germany. Russia's already, not that it's so developed, but Russia has a shrinking population. U.S. is doing okay because of immigration. If you do an interesting measurement or correlation between interest rates and birth rates, and you see that actually interest rates peaked when birth rates were, at a certain level in terms of the labor force size. So as you have more people entering the labor force, you have less productive people entering because they haven't been trained, they're not that knowledgeable, and you have all of this new demand. And as that shrinks over time with an aging society, you have to focus more on productivity, and that buying power isn't what it was because people are more interested in saving and producing income. So to make a long story short, a long-winded answer, I would completely agree with you that an aging society and the demographic trends would suggest continued moderate inflation and interest rates.
I think the Fed has such an inflationary mandate for a lot of reasons. It's just kind of an interesting tug of war to see what is going to win. producing more dollars, whether it's in a quantitative easing cycle or not, or hiking rates to try to cool an economy that by some measures could heat up. But a lot of people really don't think there's any real substance underlying those stronger economic measures.
I really don't have much to add to that. I think there is, you see some maybe one and a half steps forward and then kind of one step backwards in terms of the economic news that comes out. And it sort of all points to this kind of yo-yoing. And at the end of the day, really no movement from the Fed in terms of higher rates, even though they talk about it. And the Treasury investors are really saying the Fed is just kind of talk at this point, and they're not pricing in any sort of movement till probably the earliest, maybe March of 2016, which I think is a rational way of looking at the world and placing one's bets.
So you're obviously quite interested in economic and monetary policy, just like any investor is, and I sure am as an investor, but you might have more interest in this than other fixed interest rate real estate investors because, at least in some scenarios, you're a proponent of choosing variable interest rate mortgage products rather than fixed. Can you tell us about that?
Sure. I like to say that I have 3 children, my son, my daughter, and LIBOR, and I tend to spend more time and focus on LIBOR than my other 2 kids.
Must be the least cuddly one, yeah.
Yes, right. Doesn't talk back necessarily. But with that being said, we have found that we started venturing into the world of variable rate mortgages in the apartment business in 2003. It wasn't a real widely available product, so we were somewhat pioneers. And then as it became more widespread, it's really been at the margin, really our choice for the last 5 or 6 years for maybe 70, 80% of our new loan originations, if not higher, such that our loan balances, if you were to break them down between fixed and variable, is probably 60, 65% variable and the rest being fixed. And the reason why we've liked it is for a few reasons. One, the rates when you originate these loans are typically 1.5% to 2% lower than the prevailing fixed rate loan. You can get terms of 10 years, which is available, of course, on the fixed rate side. And probably most important is the prepayment flexibility, because a variable rate loan typically after 1 year can be prepaid at, say, maybe a 1% prepayment penalty, whereas a fixed rate loan has a yield maintenance formula, which essentially is a calculation that compensates the lender for getting their money back early. And they want to be compensated almost in a way that they didn't get their money back early. They put their money out, say, for 4% for 10 years, and they wanted that 4% for 10 years. So if you pay it off in year 3, there's a big penalty for them getting their money back 7 years early, which is not the case for variable rate loans. So what that's allowed us to do, it has given us the flexibility to either refinance those loans if we find better loan products out there, or we've added value, or we can lower the cost of those funds, or if we want to sell an investment. We think market conditions are ideal, or this particular asset we're a little concerned about. It enables us to not have to sell a property with fixed rate financing in place that has to be assumed by the buyers or the buyer. And what that does is when you force your financing on the marketplace, it tends to lower the pool of buyers and the price you would get. And so we have found that we can get not only more cash flow by having variable rate loans, but we could generate overall higher rates of return if we want to sell before the maturity.
Okay, and typically when you're getting that 1.5% to 2% lower rate by using a variable rate, that's early on. Those are the early dollars, and those are the most valuable dollars to go ahead and reinvest again.
That's exactly right. And when you're buying a new property, you really are buying a business. And so while you like to think you have everything figured out and have discovered every hidden issue or every issue, that's usually not the case. So if you're going in and buying a large community, there's always going to be something that doesn't go according to plan. So having this advantage in your cost of funds early on allows you to have a bigger margin of safety in case something goes a little awry in your early ownership period. So that's been another benefit for us.
Okay, essentially that's an arbitrage creator. If decreasing cap rates these past few years have been a problem, if cap rates don't exceed an interest rate by a certain amount, if you have your interest rate 1.5% to 2% lower, you just created more arbitrage for yourself. And I just wonder how my listener might be able to benefit from this. So I think you're talking about fixed interest rate products tied to the LIBOR. And is that something that you can use on 1 to 4 unit properties, or are we only talking multifamily 5+ here, Gary?
Well, I just want to be clear. When I talk about variable, our loans are tied to LIBOR, but they adjust monthly based on LIBOR's movements. So they're not, 3, 4, 5 year fixed. I believe they are accessible from banks on a 1 to 4 unit basis. I know I've used this on personal residences or, individual units that I've rented out. So I would think that they would be available as well for most of your listeners out there.
Yeah, that could be a great thing for a listener to ask their lender about and weigh the cost benefit of that, Gary. Yeah, well, that's great. That's a really potentially profitable thing for us to think about. Hey, I'm really happy to have you today, Gary. Why don't you go ahead and tell us what your website is?
Sure. So I have a personal website, www.garycarmell.com, and I blog there typically weekly, and there's a lot of my writings on there. And the firm is cwscapital.com, Charlie William Sam. And that's where, I've worked. And this is where, through how we invest for our apartments. And the individual website is more kind of my personal thinking about investment philosophy, human nature, whatever's on my mind. And the book that you mentioned is available at Barnes & Noble and Amazon.com. So it's fairly widely available.
Yeah, again, that popular book is called The Philosophical Investor. Gary, be sure to hug that LIBOR tonight, and thank you so much for coming onto the show.
Oh, my pleasure, Keith. Thank you so much.
All right, so some signals there that inflation will remain mild or muted. Almost a year ago on the show, global economist Richard Duncan forecast this back in GRE episode 7, essentially. So in this last year, we've seen real estate values continue to rise. We've seen the U.S. stock market go mostly sideways. Gold, silver, platinum are all modestly down from where they were a year ago, and oil down considerably over that time. Hey, well, it was great to get, kind of validation from Gary Carmell there about the turnkey real estate investing. If you would like to see a photo of Gary or thumbnail photos of all of our guests, you can do that on our website as well. Hey, special thanks today to the knowledgeable philosophical investor Gary Carmell. Next week, we've got a talented mortgage loan officer on the show to tell you how to best position yourself for investment property loans. Now go out there and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.